going on? Chris here. We're going to take a look at the what's going on in the markets and just try to get an idea of just context and try to provide the least bias kind of point, but with comments as well. Gold into strength, VIX into weakness. So when I see VIX into weakness like that, I'm looking for a reversal in VIX, and a reversal in VIX speaks to more volatility to the downside in the market. And with us so high in the market, it also makes sense for a reversal in the market, like an overextension RSI. We can take a look here, just how close we are for overextension. And we're looking here. We're overextended on the Dow, and we're getting pretty close to overextended on the daily time frame for S&P 500 and Nasdaq. But here we're seeing that gold is pretty high. Top three: gold, Dow Jones, S&P 500 on the strength side. On the weakness side, we got VIX, dollar, and the 10-year. So that's interesting. It's the strength and weakness either suggest a continuation or reversal, and I'm thinking there's going to be a reversal. Even with gold, we got some gaps to fill. There's a gap here near the lows. With that gap so close to the low, I don't know if it'll survive. The dollar's got a lot of gaps, and it's just a matter of time before it fills in. Commodities, I think it's still gonna hold. It's not gonna drop as maybe as steep as others, but I would still think it's gonna fall in reverse, just because I think the market's gonna have that kind of reaction. And then we look at the indices. We got Dow Jones, transport, and airlines, top three. Utilities, Nasdaq, and Wilshire 500 as like the three weakest. So one thing to note is utilities and small cap in the same, in the same school, in the same club. Utilities is usually for safety, but if we're expecting risk on, we wouldn't expect small cap, Wilshire 500, and then we got the small cap over here to be one of the weakest, along with utilities. So it's a little kind of weird. Like even tech is down there and the S&P 500. So for the Dow to be outpacing, it almost speaks that people want stability. They want, to buy things that have value for hardy, like that are hardy companies that have been around for a long time that can withstand some austerity. Go to sectors, RSI, sort. Now we got top three: materials, industrials, financials. Weakness, we got discretionary, utilities, communications. In the leadership, it was energy, and then it was healthcare, and then what is industrials, and then weakness, it was like utilities, discretionary, real estate, and tech. But tech got pushed to the middle. Consumer staples in the middle, real estate in the middle, energy not necessarily in the lead anymore. Instead, it's these defensive like materials, industrial. So it's really taken place, these defensiveness. So like the market's bracing themselves for just some kind of impact, and I think it's just not sure whether it's the market is going to stay and stand, and if it's going to come down, they want it to be low vol, and low vol would be defensive sectors that would do well, or that people would really scale into. But with these gaps that we see on materials, like it's all kind of riddled in here. Industrials has got some gaps, and and even real estate, I think it's gonna all fill, like, unfortunately. And we don't need to look at crypto, but we go through this section here. It looks like we got Dow overbought, so we'll be looking for a reversal there, or at least a slowdown. But we had a nice breaker to the upside, retest, resumption. So if you're able to catch that, it's good for you. We've we've kind of come to the 72 moving average, and we're kind of right there. This is like the 72 moving average, and we're just waiting for market structure break to the downside, and we could have some more upside up to this 150, but I would say we're pretty close in the final innings about a reversal happening. And we can take a look here. This has got the 150, the 72, and the 24. Roughly, if we were like a bank, we were forecasting or planning a sentiment in terms of like when we would deploy income, and it would probably be in like a 1 month, 3 month, 6 month increment. And here we can see that we were at oversold levels, and we've deployed income over the last 6 months or 3 months based on seasonality in some way, and we're getting these maybe labor reports of unemployment, and we're kind of reevaluating based on the CPI and labor and the economy and GDP if it would be worth it to keep our money still in here. And so we're coming up to some evaluation points, whether it's this unemployment claims that's coming this coming week, or if it's GDP reading that's going to be coming soon. I don't know when, but these time frames are really important in terms of evaluation of if you want to expose your money to risk or if you want to take it off the table. And I say we're getting pretty close to the banks evaluating if they want to still keep their money in the risk on position. But here we could see we still are in the weakness of the market structure break on oil. Came back and retested. If anything, if we don't close above this high here that we see above this block, this candle close high on the week, if we don't close above there, then we have nowhere else but to go down. And you could see we're getting rejected by this green line. If anything, it's making a bear flag or a rising wedge, whatever one you want to look at, like see it as. Those are really indicative of like we're at resistance and we can't get above it, and we're getting ready for a rejection. It's just a matter of time. And if we were to look at like a smaller time frame, so we looked at the weekly. Now, if we were to look at the daily, you get there's a lot of lines here, but the main thing to look at is this solid block. It was a daily breaker to the downside on oil. We had a daily breaker to the upside that made this move into here, and then now we got one to the downside. So we're lining up to go down. So I just showed you a weekly breaker to the downside. This is a daily that just now broke within the last 3 days with a retest into it pretty deep. So it's setting up for a reversal to the downside. And here we had a nice I think this is a bullish breaker on the H4, and we're waiting for reversal to the downside. We could set this as an aggressive one, and we could see like if there's a order block that's coming to break, but it hasn't. And there's a nice gap down here. It's going to want to fill. If anything, it's going to want to come down and retest this breaker, and most likely it will fail this low, and it will make a lower low, and it'll cascade. And one thing we know about oil is that the CPI reading I think is better, and it's low and it's down because of all those rate hikes possibly, or supply chain getting fixed. We have no idea what is the cause, but we can know for certain that they all had a hand to play in it, and also the demand destruction for all the psychological warfare with the Fed. But we can. Or the inflation, we just don't know what really is the cause of just everything, but with the supply. But we do know one thing is that we had a weekly market structure break. We had a daily market structure break to the downside, both to the downside, and then we had an H4, and we're coming in for a retest in this here, and we're going to see if we're going to make a lower low of the week, and a complete rejection off of this weekly order block that is right here. And whenever oil comes down, the market will come down with it. Sad to say. But the same thing is said of West Texas oil crude. Yes, this monthly order block, we're almost in it basically. Where it stops, no one knows. We could wick pretty, down into here. We got a lot of demand down here, especially in this monthly order block. There's a lot of demand down here, but that doesn't mean we can't wick pretty deep in here. And we also know that the government will be buying the low if oil were to come down to refill the SPR. I don't know. That's kind of just on their their claims of what they want to do. So we'll see. But it's the same story. Weekly breaker to the downside into resistance, bear flag forming. And I mean, we would need a close above here. This is resistance here. But I would say we need to close above this weak high close, but the up candle before the down move here. And if we got to close above there, I would say we're safe. We're safer. Like I don't know like what else to say, but we're not necessarily in a good place, even though the market is up. And we could see that daily breaker to the downside. We had that daily breaker to the upside that gave us this move into here. But now we got a breaker to the downside with the weekly breaker to the downside. And then we will look at the H4 as well. Very similar. Breaker with no retest here. And we're expecting it to retest and probably fail this low. And then send us into a resumption out of the weekly breaker on the downside, which would send us down on oil and the market with it. So we're getting pretty close. Who knows exactly when we'll reach it there, but we have received enough information that we're pretty close. Whether a week or two, who knows how long sideways we can go, but it's pretty close. Look at gold. So gold had a weekly breaker to the upside, but I don't trust it really. I would wait for a close above this up candle weekly close high. The up candle before the down move. If we got a close above that, I would feel more confident comparatively to this close above that candle. I think maybe that might be a little too early. I don't know if this is it's not set on aggressive, but I personally think it's too early. And we can still have more downside. And gold is not immune to recession or the markets crashing. So if anything, gold could be wrong. But I do think it's hinting at inflation second leg 2023, which is shown here on this window in the middle column or middle row, which is we look here at the years. 2023, we got two peaks. One in the 5th or the 4th, January, March, April, and then August, a peak in commodities, DBC. This is the Williams cycle forecast. So if anything, I think it's hinting at that it sees that this inflation or stagflation is sticky and that the Fed can't keep this up. If anything, they've reached kind of their limit and they have to let it play out until insolvencies increase, or just I think the Fed's going to have to maybe capitulate in some way and keep maybe rates at a certain rate and just keep it high for a long time. And that's the theory of just what's possible of happening. But with the CPI coming down, that's kind of to be expected. That we can see in the Williams cycle forecast. We expected CPI to be down at least somewhere between this September to December in some way to hit a low, and it's almost in the services. It's so sticky. So things to really look forward and just see what's going to happen. And then Bitcoin definitely not something that's noteworthy right now in crypto, the whole crypto market. Um, Still under a weekly market structure break to the downside. I wouldn't touch it with a stick. And then the euro. So this one's interesting. I almost think I think it's deceiving in some way. I just want to see if this is aggressive. It's not. But we had a weekly market structure. Yeah, once we start this week, we've basically had a weekly market structure break. We did get a weekly close above here, but for just kind of in the environment we're in and just how risky things look, I would just step it up to the next one, just because we're we have no idea just if this euro is going to hold. I mean, I think maybe the euro is really just keying off of the dollar falling. I don't know, but it's this is the this and gold is kind of just the aberration of just like we don't know. I don't know, like the gold and the euro. Like I think they're end up gonna have to. They're both gonna be falling in some way. Um, Past maybe equal low or lower low, but this strength, I think it's too early to tell. It needs a retest. If anything, it needs a retest, and we're gonna see if it can hold the lows or that retest. So, if anything, it's too early to tell for the bulls if things will continue. And this is the point where the bulls have to suspend their judgment. If anything, Jim Cramer's going to come out and announce that the bottom is in. And whenever he does announce that the bottom is in, you really know it's not in. But yeah, that's going to be a really interesting phenomenon. USD JPY. So looking here, remove the gaps really quick. We did hit, let's see, does this need a refresh? So we're into support here, roughly the 72 or this high. We're going to find out what happens between the dollar and the Japanese yen, if we go higher or lower, or if the dollar weakens. But I think we're pretty close to, I don't know, like I guess we don't really have to worry about this. It looks like no matter what, if we put in aggressive or not aggressive, but yeah, I think we're watching patiently just what's going to happen and how this unfolds with the U.S. dollar versus the Japanese yen. But we'll look at the index of these things and then kind of make a conclusion later. And then here is the NASDAQ. So the NASDAQ supposedly had a weekly market structure break to the upside. I'm a little surprised these ribbons are back. Oh, shoot, not the ribbon. Whoops. Let's see. I want... Yeah, that one. There we go. No gaps. But in the ribbon's back. Yeah, weekly market structure break to the upside with NASDAQ. I would kind of no entries until a close above this level, the up candle before the next down move. We got two weekly up closes, and I would want to see some proof that the bottom is in. But this weekly close above this high, I think it's too early. And with no retest, really, we need to see it test these lows to really give us some confidence of going in there. If anything, it's just as bad as trying to catch a falling knife as catching a trend continuation. I just don't. I'm not convinced that the bottom is in yet, even though we've had some signs of strength on, oddly, the euro versus the U.S. dollar, the S&P 500, and tech and gold. It's just a weird combo. So we're just kind of taking it as it is. Might as well just revamp all these. ETH. I don't know. It's looking pretty weak. Looking like a bear flag, if anything. If I had to say anything, looks like we closed below the 150. So I don't know. I just wouldn't be anywhere near it. And then here, ExxonMobil, we're made equal highs here. So this one's really interesting to watch in the next week because of these this equal high or purge and then come back below this equal high. And we got a nice gap. Look at that gap to fill. I mean, it's got a couple gaps here. And, this is, I would think, a leading indicator of what's going to happen to the market just watching ExxonMobil. And we had a H4 market structure break, and I don't know, the bears look like they're still in that breaker. And we have to wait and see what happens this week. It's not over. If anything, we're waiting to see what happens after it fills it. Does it hold? Or does it totally break down on the daily? If it breaks down on the daily, it's over. We're on our way to the downside. The Dow, we have to close the week above this candle here, and it looks like it's struggled. And if anything, we might see a resolution in this coming up in this week. We're going to find out. Does it hold here or does it get rejected? That's the ultimate question we're waiting for is the leadership in the Dow and energy and what it's going to do. And we're seeing just weird divergences, whether it's oil breaking down or going to break down, or if it's the yen increasing in value again and the dollar decreasing in value. Those are like the yen is definitely a risk-off currency. Also the Swiss franc, and they're both strongest. If we go to FinViz and we go into the currencies, the Forex, and we look by 1 day relative performance, the yen and the Swiss franc are pretty strong comparatively against everything else. So risk-off currency pairs are definitely strong right now. And we'll get into this. We're almost there. Here, we'll look at the dollar index. So interestingly enough, we looked at Euro USD, but this is just the dollar period, and it's on a slower. Slower. We just had a weekly market structure break on the dollar, so this is almost suggestive of a top in the dollar. In some kind of respects, it almost suggests that with a weekly market structure break to the downside. Some people are thinking there's going to be a resurgence in the dollar, but I don't know. I think it's a little harder to kind of justify with such a significant market structure break. If anything, it's almost suggestive that that's the top. And one could see this and be like, yes, higher highs in the market, the top in the dollar is in. But I would say that this is just the beginning sign of recession. Weakness in the dollar, strength in risk-off currencies, and that's kind of just, we got to break to the downside of the dollar. We're going to retest it. We're going to see where it goes. But I'm thinking like it's not going to be good. And it's going to put a swing failure pattern here. And we're going to consolidate for 3 months, probably into the first quarter of 2023. And then we'll climb back above and maybe reclaim this, this breaker to the upside. And I think that's most likely what's going to happen. But this weekly market structure break on the dollar is significant, almost suggesting that the top is in for this year. All right, the euro, one has to kind of guess what's going to happen to the euro. This is almost suggestive that it might continue going higher. If we did our trick and we just did the weekly high close, just to be sure, we want it to close above 1009.4. If we got a close above there, we would have some high confidence that the euro would continue to gain strength. Right now, I would say it's in this like no man's land, right at the 150 moving average. Maybe it's the 150 weekly, and we need more information to know if it's going to continue. And if we look at the yen, the yen, we're getting close to breaking the weekly to the upside. So the fact that this is getting strong enough to get close to breaking the weekly sets off alarm bells. We're not close yet, but that's not to say that we won't be there yet. We got some market imbalances or gaps to really to fill, and we're waiting to see whether it's this week or next week if we break to the upside. Right now we're in resistance, so we're in this no man's land for the yen, but we're seeing a lot of strength. We saw a break on the H4 to the upside. We saw this is a monthly, here it is, H4. We saw a break on the daily here to the upside, which is going to retest here. And we did close above this daily close here, but a nice retest, and then another chance to attack this high would be really interesting to see what it's going to be like going forward. We're going to see it's on the slow mode as well, so we're going as slow as we can on these order blocks, and we're gaining some significant just evidence that the yen is gaining strength. And if we see a resurgence or a weekly market structure break on the yen, we already saw a weekly market structure break on the dollar. That kind of force where we get some really strong yen against all the currencies just speaks louder than words. This is the Japanese index against all other currencies, and if we were to break that weekly, we know it's definitely risk off. It's in this no man's land between the daily and the weekly breakers and or order block and breaker, and so we're gonna wait and find out. But with the evidence of just the oil and the VIX being so low, I say we're getting pretty close to the final innings. Now, when you look at the VIX, we look at the smaller time frames, we're still not broken out to the upside. I mean, we had some false breakouts, but now we have the daily breaker lining up really close to the H4. So it's almost suggestive that as long as we hold, we have a huge chance at these lows to really crack open this daily breaker. So we're going to find out coming up in this next week, if things are going to continue. So one thing that's interesting is if we were really on a risk-on kind of atmosphere, looking at the small cap, that the small cap would actually break out above the weekly, and the fact is we haven't. And interestingly enough, the small cap is the only one that hasn't had a weekly market structure break to the upside. The Dow had a weekly market structure break to the upside. The S&P 500 had a weekly market structure break to the upside. And then the NASDAQ, just this weekly close, had a weekly market structure break to the upside. So the fact that the Wilshire is the slowest to the party for risk-on behavior almost suggests that it's not really risk-on. It's almost suggestive that, like, hey, things are a little more cautious, and the risk to the downside's higher. It's almost kind of what it's saying to me, is people are a little more cautious, and they're waiting, and I would too, and I would personally wait until we get a close above this weekly high. If we go lower, then we could adjust it to this high, but we're not there yet. I think this order block is going to hold, and it's going to push the Wilshire small caps down to the downside, a little lower, wherever we're going to fill the gap. I don't know, it looks like it filled the gap already. Maybe it already had equal lows, so maybe we come into this demand down here. But I think that's kind of what's going to happen. Copper, we're still, we're still under a bearish weekly order block. So this kind of move, this close is nice and strong, but it's got to retest the breakout of this thing. And who's to say that when we retest that those bulls won't still be there to hold it, right? If anything, this could be still part of the huge rising wedge and consolidation, and that's represented by Just these moving averages trapping price in this pattern, huge bear flag or rising wedge, and some way to break down. But I do think it is signaling, like gold, 2023. I think it's revealing its hand. 2023, there's a huge chance we're going to have a second leg inflation, and I think that's what that copper and gold strength increase is really kind of saying. But what's weird is lumber, which is also supposed to be related to copper in terms of growth, is not repeating the same thing. If anything, it's just metals and mining that's gaining value, and the lack of strength in lumber is worrying. Like, if anything, there's no real, if no new construction is being made. If anything, copper could be used for other things outside construction, and copper is also manipulated more than lumber. But the weakness in lumber, I would say, is more dominant to the whole growth kind of narrative. So small caps, not broken any market structure. Copper, not broken any market structure. Lumber, not breaking any market structure. This might be a false breakout on all the weekly market structures on S&P 500, Dow, and the NASDAQ. So that's what I'm kind of purporting here. And then as far as like commodities like on this weekly looks still good. Could be heading for equal lows here. Still think with this failure of this last week low that and close below it that we're going to be attacking these lows. And I think that's the same for corn, coming possibly into more demand, and then soybeans, similar, going to come down in this monthly order block. Nat gas, definitely looking very similar to oil, come down to these to demand down here, and possibly an equal low, if anything, and then shoot back up, and then gasoline, looking like we might come down into here, or equal lows here. So we'll get some relief on gasoline maybe, because it looks like a nice rising wedge or bear flag into there. But that's kind of just what I would, at a glance, just what everything is saying. You heard me talk about just kind of the weird divergence of the small cap not really breaking out versus all the other indices breaking out. It almost suggests that the risk on behavior is fake, because usually small cap leads on the risk on behavior. And then also with copper, even though it broke out, it made a strong close above that weekly high close, we are still below the weekly bearish order block. We didn't break it. And with lumber still weak, and just the lack of proof of growth, it's almost kind of like a false signal. There's these false signals all over the place, whether it's the euro, or it's gold, or these breakouts on the indices. It's almost like some kind of sensational, buying, like at the highs. That's what I would put it akin to. But other kind of macro that we can see into the liquidity is really interesting. This is more of like the long-term time frame kind of view. This is the Euro-dollar futures. If we go to 2023, going into 2023, we're seeing up to 5.3. That's roughly the rate hikes of what we're expecting. Not necessarily something that will, use as a barometer of like how the market's going to go. But we do see that this kind of bottoming here, we're expecting something significant to happen around this time frame, around 2025. Just something significant to really happen during this time frame for some kind of significant event. Like I think maybe we'll get like a small recession going in, or at least a last push to the downside. But 2024 is going to be definitely more significant. Yield curve inversion, we've already hit, if we look at this number here, 50%. So we were up from last week, which was 43%. So we're 10% away from 60% of the yield curve inverted. So we're really in a U.S. dollar shortage, mostly seen by these two metrics here, with this euro dollar futures priced so high on the March 2023 contract, the contract that's 1 year from now, basically, or less than a year. I think it's like 8 months, 8 9 months. The peak in that is suggesting high demand in Eurodollar futures, which is Eurodollar futures is basically U.S. dollars in foreign banks and offshore banks. And when we look at the the yield curve with the inversions of the curve, where the forward yield, like the 13-week or 3 month, with the demand so high, it's almost suggesting the same thing, that the demand for the dollar, or liquidity that the dollar provides, something that's treated equal to the dollar, which is forward yield treasuries, like the 3 month or 13-week, gaining strength, and that being inverting the yield curve, is a dollar shortage, like a dollar shortage sign. So that's something we could see there. So that was two forms of that. And then the dollar index, or Euro USD, is like another form of that. But we'll look at the banks, just how they're viewing liquidity right now. If 2019 was a scary time right before the COVID nuke, right now we're above that zone. So reverse repo, banks are willing to go to reverse repo. They want their money safe and liquid. They're willing to pay a premium for that. And right now they don't want to put their money at risk, so they'll go to reverse repo. And we can see the demand right now. It's past the demand for 2019. So that's significant in that kind of context. SOFR minus secured overnight financing rate minus reverse repo, there's a negative spread, suggesting that banks are willing to pay a premium over SOFR to get reverse repo. And if we take the 10-year as well, 10-year is pretty equal to just security for the future. The 2-year is more equal to like cash. But yeah, definitely 2-year and below is equal to cash. But like security for the future, we could see that the banks don't have any like appetite for risk and security for the future right now in the near term. And there's a negative spread between the 10-year and reverse repo. So the banks are more willing to pay for reverse repo than the 10-year, so that they see value in the reverse repo. And then the basically the Dixie inverted. I'll go back to candles here. We've gained some strength, but definitely look like we're in some kind of a bear flag here too. If we just look up the Dixie, just really interested, Dixie futures on the dollar index. We're gonna wait and see. Maybe the peak is in. We're gonna find out. But right now we're just kind of waiting and seeing what's gonna happen with the strength. So this the FX swap. So this is the FX currencies. We looked at Eurodollar futures. We looked at the reverse repo. We looked at the treasuries. And the treasury is getting worse with the FX swap. This one's a little interesting because FX swaps, it's leverage, it's a contract, and these aren't really recorded on the balance sheet. Treasuries are. So we could almost say that Eurodollar futures is probably the hardest detail next to treasuries in terms of just kind of safety and liquidity. And then FX and these kind of derivative contracts of currencies is more of like the weakest form of just related to the dollar shortage. like how in the world do you, I guess, um, assess for dollar shortage? I guess one way would be the RSI. We could take a look on. Maybe we should look at the weekly. So we can look up RSI load oscillator, and we go to Dixie here, and then it looks like we're able to right here, and it looks like we're a little bit below the 50. It doesn't really tell me, but we're almost at a really good buy point. I don't know, like maybe I don't know what to say, but it was a lot of strength going up. Now it's definitely lost that strength, and I don't know if it was really predictable to short that top, but maybe once we left that zone of the RSI band. But we're pretty much in the middle, and we're going to find out if we reverse at all, or if we could just continue down. And we're going to find out just how things go. But what's it called? We're going to just keep a close eye on it. But yeah, that's the dollar, right? And then we we'll look at so this is the NFCI. We did pop below this box, so like I guess things are getting better. Not 100% sure, like we're so close to it. So that's something worth taking note. This is the consumer sentiment side, weak, and then manufacturer. So this is the business side. It's weak. So basically fragility on both household side and business side. 3-month, 10-year inverted. So the one thing that's significant here is this weekly close. If we were to look at this closer, and so this line is a zero line of inversion, and we were to take the high up candle close, we closed above that, and then we try to find another one that's higher. Well, we closed above that, so it's almost telling that the last close that was an up close is this one. So it almost suggests it's going to go higher and inverting unless it breaks down. And this, in terms of supply and demand and market structure, this is telling that it's just going to continue going higher. So this is another kind of evidence for the breakdown in just the treasury demand for the shortage. And yeah, it's just kind of scary. And I think also during a recession, anyways, that people dump currency FX in dollars and go into forward yield treasuries. Like I think that's more of a thing. And I don't know if even the TLT is escalating. Let's take a look at TLT. Is there? And I guess there is a little bit of a wick there, but no real strength. Maybe if we reclaimed this last quarter low, that there would be hope for it. But right now, it's very uncertain whether this TLT is going to start reversing. If we put it to the weekly, would we get anything? And I don't know. Let's. Is there a market structure that we could see? So it looks like, yeah, I don't know. We would need a strong close. So resistance is here. It looks like weekly breaker to the downside. We haven't retested. And if we look at maybe H12, looks like we kind of had a breakout. Want to maybe fill this gap really quick on the retest. I don't know. To be honest, TLT might be the play. Who knows? Um, I don't. I need a weekly breaker to the upside on TLT, or at least a reclaim of a weekly close above this last quarterly low. That's what I would like. all these weekly down candles, it just looks terrible. Like I'm not comfortable with TLT. But finishing, we go to let's see. So that's the and then this is the 2 and 10, still high inversion on the 3 month, inverted. So it's I don't know, 2 year, 10 year, 5 year, 30. They're all inverted basically. So now the credit spreads. So credit spreads. This is the high yield growth credit spreads, and this is supposed to be the most riskiest form. But the thing is, we had a weekly market structure break to the downside, and that could be seen from this breaker. We load it, and we had a weekly market structure break to the downside here. It was on this candle, and we've been retesting here, and it's forming a bear flag. So if anything, that's telling what we didn't fill this gap here. So this gap remaining unfilled for a retest to the downside is kind of scary. So we're waiting for weakness to come in to the credit spreads of HYGH. But from the way it looks like it's a bear flag. There is no other way to call it. It's something different. It's a bear flag. Weekly market structure break to the downside, retest, and we're having lower highs. Yes, higher lows, but we got to retest and fill this gap here between this candle and this candle. And we could call it maybe a fair value gap in some way. And this fair value gap has only been filled partially. It's going to be a magnet to price, and we're going to see if it holds this low. But you don't want to be the one to find out that it doesn't hold the low on credit spreads, because that's pretty much when the neck snaps off. And then we got the long-term credit spreads, and just looking at the near term, yes, it's in this like breaker, bullish breaker, but if we were to just narrow the window, and what do we see? We see that we have a breaker to the downside that we're currently retesting, and what's expected is that it gets rejected here, specifically at that line. It's going to find resistance, form a bear flag on the long-term corporate credit bond credit spreads, and get rejected. So this weekly breaker to the downside looks like it's it. Like we are probably the earliest to see some breakdown in comparison of credit spreads to the market, both on HYGH and LQDH. And then we look at this is lumber versus gold. We put this in the 3 month. Turn off the market structure break indicator. We are testing the lows here on gold strength versus lumber. Lumber weakness, and the lumber is supposed to be signify a growth, and because it's gone down, it's weak. So that's not looking good. And copper versus gold, still weak on the copper versus gold. Or precious metals versus base metals, same thing. I mean, they're both saying the same thing. And then this one's interesting, junk versus TLT. I kind of want to see what the market structure has to say here. And here, we're kind of waiting for a retest. And why I'm saying that is specifically, maybe it did get a retest here on this breaker. But it does look like it's at extension. We did close above this high on the week, but we also got rejected pretty hard this week. So if we were to come back to the moving averages here and start reversing trend and failing levels, and there's a gap down here, the gap is right here. If we were to come back and fill it, it'd be pretty telling as to a collapse in the bulls of junk corporate credit bonds versus TLT long-term treasuries. So we just need to see like a return to this gap, and it would probably be solidified that the market is going to be in weakness. But we are in the final innings of it. finalizing whatever price discovery it's trying to find here of just a higher highs. I just don't know when and where it'll be finished. And then this is the move index, and the move index usually leads volatility, and we came all the way up here near the COVID nuke high of the move index, and now we're coming back, almost suggesting that volatility is on the way and it's going to cool in some way. And then XLY versus XLP, we dipped down below pretty hard. I don't know what to say. It looks like it's nice. There's a nice stop hunt in there, but off of the weekly market structure break, so we're still bearish. We need to close some weekly highs, and it looks like man, if we were to set a point of when consumer discretionary is back for spending and risk on, I would say above this last quarter high or this weekly candle high, close above that would be like a good place to kind of call it as like, hey, we're really bullish now. Consumer risk on spending is back. But I say that it's not over, and if anything, it would be forming a bear flag here to the downside. Before, I think we just stopped out this low, and we got some propellant power to go up, stop out of liquidity, and we're just gonna range. I think we're gonna range on the quarter of the month. But once that's over, we're going to see what happens. And this happens to be a quarterly breakout to the upside with a retest. And we're going to see what happens if how much we can hold this breaker to the upside. But I don't know. And this is kind of the idea of stagflation, is if this were to break down, is for stagflation to really kick in to where the consumer is basically dead and prices, liquidity is moving slow, and the cost of everything's going higher. But that's pretty much it for that on liquidity side. And then if we were to look at forecasts really quick, so this is the S&P 500. We're assessing that maybe the fast cycle's correct on the top, and obviously that's not true. And we assess the window for the bracket of a possibility of a top would end near 1110, and we're into the weekend of that curve, and we're going to find out if that is true or not. I think we got maybe a couple days to figuring out whether unemployment claims on Thursday is really going to favor this timing solutions forecast. Honestly, I have no idea what's going to happen. Maybe the top's going to be in somewhere around December, the beginning of December. That's possible. But with my kind of assessment and the way I did it, I already positioned in short, and I'm just going to hold it. I'm going to hold it, make some adjustments from month to month, but I'm ready to just go short, even though it's super early. If we waited, the correct way would probably wait until ExxonMobil has broken a daily market structure to the downside. But I'm wanting to take this opportunity to learn in just a roundabout way. And then this is the forward treasury yield, and we're moving up here on this cycle. And we're going to find out what happens at the peak. Do we break out? But we just got a couple more days. If anything, if we were to use this, it says 11:13. So it's roughly Monday to the 14th, Tuesday. So if anything, we could see a lot of volatility to the upside come Monday, Tuesday. Who knows? But we're seeing a lot of news with crypto and the exchanges, and just the whole debacle of that, and how that's going to affect other funds, and also how that's going to affect other bankruptcies for liquidity-wise that have invested, companies that have invested in crypto. And then here, So we got the two fast indicators. One is the Q Spectrum 2, which is this committee line from all these auto-selected AI cycles. And it does look like this is gold, that it's going to be starting to roll over. And that makes sense for a retest on the weekly market structure break. So we're going to see what happens with that. So in effect, gold, it's a good short opportunity. That's what it's saying to me. And then, with the bill coming up into a peak, you just kind of want to stand back and watch. To wait and see what happens on that curve. Does it keep on going, or does it break down? Like, we want to see a reverse if we're bullish. And then with S&P 500, we're looking here, and it's right around that peak. And we look at right now 12, 13, 14. We're pretty close to the beginning of the downswing. It's either here or, the next one is December 7th, roughly around there. So first or second week of December. One thing I'm kind of curious about when is quad witching. Our 2022, just to see what it's saying. So it's saying that December 16th is the next one, and then we go to Forex Factory, and we got unemployment claims on the 17th. So I don't know, like, we can't really make a huge judgment here, but according to this is saying the 17th is unemployment claims, and according to this fast cycle, it happens to be the peak in some way. And then according to the hard cycles, I don't know, there's this divergence that I haven't really encountered a whole lot, and the edge is eroded in some way, and you have to kind of, because they're not in line. Like, the hard cycles are in line, but the fast cycle is not. And until they get in line, it's hard to be confident. If anything, you have to kind of make a window of when something's going to happen, and just rely on market structure and just significant market structure breaks. But which is probably the best thing to do. Just go for a high time frame market structure break to the downside, and then eventually with the really good risk management, you'll get it. And I think that's just the best way to go about it right now. Just as long as we don't hit those points where we're wrong on a weekly close above, we're going to be continuing looking for possible dates to the downside. One thing we could do to also kind of assess a second fast would be this trading spectrum. And this trading spectrum has also got the 16th and 17th kind of in view. So let's take a look. And I think that's unemployment claims. It's the 16th and 17th. So that's like a really interesting date to really be prepared for this coming week. That's kind of just the best I got in terms of making sense of the divergent forecast of S&P 500. The divergence makes it more difficult with the edge because it's not a consensus. But with the fast, we're seeing a consensus with the 17th, and it's tied to the unemployment claims. And that's something we could actually prepare for and going off of just waiting until the 17th, or kind of a purge above the last week high to possibly get a position for the downside, or H4 market structure break to the downside, getting close to the 17th. And that's kind of just the way I would go about it. But that's kind of what we're expecting as far as like further as things go on. It's just really confirming with the retests, whether it's the tech weekly market structure break, gold weekly market structure break, the other kind of market structure breaks that have broken out, just to see if they're really what they say they are. and if that is the low. And we're going to find out on this unemployment claims just how bad it gets with Facebook and their announcement of letting go of 11,000 jobs and just any more jobs that get let go. I mean, we could look at daily job cuts. So I don't see Facebook in their 11,000 jobs, but Meta plans on 1,000 plus job layoffs this week. I don't know. The numbers don't look that great in terms of like numbers wise. Credit Suisse take 9,000 layoffs. I don't know. I'm expecting maybe a surprise on this unemployment claims, just because of all the money lost in crypto and just the markets, and I don't know, like it, it just doesn't look good. I mean, if anything, in the RSI. So here's another thing we haven't gone over is the RSI and just everything. So we look at the weekly RSI. We can look at the SP 500. So down here, we'll look at this. We're basically at resistance here, and we're gonna find out. It's really close to figuring out if this is a reversal or not. This is the weekly, and if we were to blow this up, we're near the 50 mark on the. This is an RSI Bollinger Band, and this middle zone is usually a good point to sell for oversoldness. And we're into the middle of the RSI band. We're into the moving average channel, 20 high, 20 low. We're into this weekly bearish trail, and I say we wick above this last week high, and that's it. Like I think that's there's not a whole lot to go off of, and if we were to go off of a fair value gap. We put this on the daily, and we look at the fair value, and we were to fill it. So it's roughly here, and you can see just how close we are, and we'll sync it in the layout. So that's the daily. I usually keep this on the H12, and we're going to turn that off and put this back on. I mean, we could wick all the way up here and then come back down. It's totally possible. I'm suspecting something a little different. Taking if I turn this on, turn this off, and we're using the this right here, the daily. Let's see, we want it a little darker. The daily market structure break right here as an entry point. We want it to go above here and an H4 market structure break at this near these zones. This is like basically the zone where we watch for an arch H4 market structure break to the downside, which is around here. The breaker that went to the upside here that broke down and lost on this that was made by the bears holding staying in this candle. So we're using this as kind of a guide, and it happens to be where the top of the RSI band is. So we're just waiting for an H4 market structure break to the downside here, but I think we're honed in pretty close to the top, and if we got above the last week high and purged it right there, and we wouldn't fill the fair value gap completely, but we would fill at least 50%, and I think that's good enough. I mean, it could go the whole way, but I don't know. I don't see. I'm not prepared for that happening. I'm prepared that I think it's going to get defended, and it's going to wick above, step out the last week bears that they got into the close right there, and it's going to spike out up above and then come back below, and then that's going to be at H4 market structure break, daily market structure break, down, and in line with the weekly market structure break to the downside on the S&P 500. Going down into liquidity, possibly down to 3,200, 3,000 on the bottom of this weekly RSI. So that's kind of just from a big at a glance view to just kind of my comments to just looking at the asset classes in context to just kind of my assessment analysis on just where we are and what I expect with also the forecast. Right now, the money flow index here is eroded its edge. I mean, we're in the middle, we're neutral, so we can't use this. There is no real edge here. The only edge we can really go off of is just high time frame market structure breaks and just waiting. And fundamental numbers coming out like unemployment claims and seeing how it lines up with the timing solutions and what that says. But other than that, it's kind of just what we're going off of and what we're planning for coming out. And also make a separate view on just kind of crypto and targets and just kind of what I'm thinking. Right now, I'm kind of in a diverse group of crypto on the short side, and I'm thinking about going all crypto short, and instead of just some S&P 500 or mostly S&P 500, I'm thinking about going dominant in a crypto short on one coin, 100%, and the rest would be 40%. But I have to find out which one that will be. But that's kind of just where we're at right now. We're kind of in this weird choppy zone, and we're trying to find a top, and that's kind of the best that I've been able to figure out as a way to get close without really catching a knife on the top side is like finding ways to kind of temper, going into H4 market structure break, like a zone to wait for, to hunt it, to get a really good entry to the downside. So that's the best I got. So thanks for watching and see you in the next video.